Hey everyone, welcome back to Corporate Decoder, the place where we decode the cryptic language of corporate filings for you. And sometimes we find secrets that companies would rather keep hidden. Today we're diving into Ovintiv Incorporated's latest report, a Form 8K. Now typically these are for big events, and boy did Ovintiv have one. They've announced a massive acquisition and we've got all the juicy details right here. So what is the big news? Ovintiv, a major player in the energy sector, is acquiring Nuvista Energy Limited. This isn't just a small purchase. This is a stock and cash deal, meaning Ovintiv is giving up its own company shares and cash to buy Nuvista. Think of it like this. Ovintiv is essentially trading some of its company pieces and money to bring Nuvista into its family. This whole deal is laid out in what they call an arrangement agreement. It's a pretty standard document for these types of big company mergers. It basically outlines all the terms and conditions of the acquisition, making sure both sides know exactly what they are getting into and what needs to happen for the deal to be finalized. The company's boards have given this a big thumbs up, which is exactly what you'd expect when such a significant move is on the table. Now let's talk about the price tag. For every share of Nuvista that isn't already owned by Ovintiv's group, shareholders have a choice. They can take 18 Canadian dollars in cash, or they can take about 0.344 of an Ovintiv share for each Nuvista share they own. Or they can mix and match, taking some cash and some Ovintiv stock. This gives Nuvista shareholders a lot of flexibility in how they want to receive payment for their ownership. But here is a catch. There are limits. Ovintiv is capping the total cash payout at about 1.57 billion Canadian dollars, and the total shares issued at about 30 million. This means if a lot of people want cash, they might get a bit less cash than they hoped for, and if they want stock, they might get a bit less stock. It's called pro-ration. It's like when there is a limited supply of your favorite cookies at a party, and everyone who wants one might only get to take a few. For this deal to go through, there are several hoops Ovintiv and Nuvista have to jump through. They need approval from shareholders, which is pretty standard. The courts in Alberta have to give it the nod. The stock that Ovintiv will issue needs to be approved for trading on major stock exchanges like the New York Stock Exchange and the Toronto Stock Exchange. And then there are the regulatory approvals. They need to get the green light from the Competition Bureau in Canada and the Investment Canada Act. These are essentially checks to make sure this acquisition doesn't harm fair competition in the market, and that it is in the best interest of Canada. The agreement also lays out an arrangement outside date, which is basically a deadline. If the deal isn't closed by May of next year, either side can walk away. However, if regulatory approvals are the holdup, they can push that deadline out by another 3 months. This just adds a bit of urgency to getting those approvals in place. Now, in any deal like this, there are always protections for both sides. The agreement includes things like non-solicitation clauses, which means Nuvista can't go out and try to find a better offer from another company for a certain period, but they do have what are called fiduciary out provisions, which means if Nuvista's board truly believes a better offer is in the best interest of their shareholders, they might be able to consider it. And there are termination fees. If Nuvista backs out under certain conditions, they might owe Ovintiv a hefty 130 million Canadian dollars. On the flip side, if Ovintiv has to walk away because regulatory approvals aren't granted, they might owe Nuvista a similar termination fee. These fees are pretty significant and show how serious both parties are about the deal, but also how they've planned for potential failure. This next part is a bit technical but important. The shares of Ovintiv stock that will be issued as part of this deal are being done so without the usual registration process with the Securities and Exchange Commission. This is allowed because the deal needs court approval, which acts as a fairness review for the Nuvista shareholders. It's a way to streamline the process when a deal is being overseen by a court. Now, every company report has this section called forward-looking statements. This is basically the company saying, hey, some of the things we're talking about might not actually happen. They're making predictions about the future, like whether the deal will close, how well it will integrate, and what their future performance will look like. They're required to do this to protect themselves legally. We should always take these statements with a grain of salt, as they are essentially educated guesses about what might happen. The big risks they highlight here are pretty standard for acquisitions. The deal might not close at all. It could take longer than expected. It could distract management from their day-to-day business. There could be legal challenges, and the promised benefits and cost savings, called synergies, might not materialize or might take much longer to achieve than anticipated. This is where understanding the business and the market is crucial. Are these risks manageable or are they deal breakers? And finally, they list the exhibits. This includes the full arrangement agreement. If you are a real deep diver, you can read the whole thing, but we've given you the highlights. So what is my take on this? Ovintiv is making a bold move to grow by acquiring Nuvista. This is a classic strategy in the energy sector. especially when companies want to expand their operational footprint or gain access to new reserves. From a Walmart perspective, this is a big bet. They are betting that they can integrate Nuvista effectively, realize those promised synergies, and ultimately make more money from the combined entity than they could separately. The dual cash and stock offer gives Nuvista shareholders a choice, which is good, but the proration means some might not get their preferred option. The biggest question mark will be regulatory approval. If they can get that, and assuming the integration goes smoothly, this could be a win for Ovintiv. However, if regulatory hurdles prove too high, or if the market for energy stocks shifts unfavorably, this deal could become a lot less attractive. The termination fees are high enough to make both parties think twice about walking away, but they also signal the potential for serious disruption if things go wrong. It really boils down to execution. Can Ovintiv management pull off this complex integration and deliver on the promised value? Alright, that is our breakdown of Ovintiv's Form 8K filing. What is your take on this acquisition and what it means for Ovintiv's future? Drop your thoughts in the comments below if you found this analysis valuable. Hitting that like button really helps us out. And subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community. The link is in the description to continue the conversation. Thanks for watching. See you next time.